Good afternoon. Welcome back to Money Control's live stream. You're watching Closing Bell with me, Lovisha Darad, and joining me, my colleague Yatin Mota. Well, what a remarkable day we saw, and while we were hoping for some recovery after yesterday's 7-month lows, today has been quite a great start, given we did have a muted global handover to start off with. But yes, what helped today and what was the shining point of today's market was the bank stocks after RBI's liquidity measures came in. Nifty did close above that 22,950. It did reclaim those 23,000 levels. However, it did see some profit booking in the last 30 minutes or so. Sensex also rose about 500 points. Did see about 1,100 points gain in the intraday session, but right now it's settled above that 75,900 odd levels as well. Now, as I mentioned that the big heavy lifting in the bank stocks were seen during the day, Nifty bank index definitely rose almost 2% gains coming in from the index as well, where it did cross about that 49,000 mark. The majority of the contribution came in from HDFC Bank and ICICI Bank, which rose up in the range of 2 to 3%. All the other sectors, auto and realty indices also moved with a good set of gains, 1 to 2% gains coming in. On the other hand, defensives, if you look at the contrasting picture of the market, defenses did took a backseat, and we saw FMCG and Pharma seeing a cut of about up to 2%. That came in for that. Broader indices, however, that continue to remain the mood dampener today as well. Mid caps and small caps continue the third day of decline. Small caps heavily hammered yesterday, 4% declines, today 2% cut coming in. But yes, overall a good market, but broader markets continue to see the pain point. Yatin, a great relief rally for the markets today, and definitely the talking point was the RBI's liquidity measures. That has given a set of the tone that rate cut hopes will be dialed up in the February meeting as well.
Absolutely, almost a rate cut coming before the rate cut, and if you look at the RBI liquidity measures clearly working for the markets in terms of sentiments, almost 1.5 lakh crore plus kind of a liquidity infusion is what RBI announced. Well taken by the markets. Good recovery in the financial services stocks, be it the PSU banks or in the private sector banks or NBFCs, everything was doing well. In fact, the last 2-3 trading sessions we had the advanced decline ratio, which was almost 1:10 plus, which means that for every one stock there were 10 stocks declining. But today the market breadth was almost 1:2. So for one advancing stock, we had only 2 declining stocks. Obviously, result reaction continues to be violent. If you look at stocks like Apar Industries fell 20% after numbers, Power India, Keynes Technologies, Netweb, all of these stocks clearly taking a hammer. In fact, Keynes Technologies, they reduced the guidance by less than 10% in terms of annual revenues, but still the stock dipped as much as 20% in intraday trade. We had stocks like Anantraj and Netweb, clearly fears of China entering the artificial intelligence wave, creating shock waves across data center companies as well as companies related to AI technologies. What was doing well on the contrary is real estate stocks, especially the likes of Sobha up 10%, Credit Access Grameen after declining 30-40%, the stock managed to recover 7.5% here, and Chola Finance also recovering 6%. So it was a good day for financial, as I mentioned earlier, but the volatility continues. And to understand more on the markets, we have veteran Deven Choksey sir joining us on the show from DRChoksey FinServ. Deven bhai, it's great having you on the show. When it comes to the markets, obviously a state of confusion among investors. There is a lot of panic in the markets. What do you make out of the current scenario, especially in the light of a probable change in stance at RBI as well as the union budget approaching?
Yes, Yatin, good afternoon. Well, I believe that I think the collateral damage has happened because of the significant amount of losses that investors have incurred in the small and mid cap stocks, also led by the surge of IPOs that we have seen in the last 24 months. Of course, the momentum has broken into them. The steep valuation at which they were quoting, they are not the reality as the growth is tapering down. And as a result of which, I think the victimization happened also with the large cap stocks, because in order to pay off the losses and also deleverage their position, the traders, the new traders that we call them as, have actually, I think, sold their family jewels by way of selling some of the large cap stocks on which they had set the collateral. So that damage, to my mind, I think is largely over as far as the market pain is concerned. Still, we may have some more pain left. I think largely because of the fact that the FII is also taking the money out of the market due to some part of the valuation concern that they carry. But on the whole, I believe that I think if the larger part of the sell-off is complete, then probably I think one should look at the new trigger points. And as you rightly started mentioning about the RBI's credit policy, if they infuse the liquidity into the system, that does indicate that there is a requirement of additional funds flowing into the system. There is a requirement to bring down the cost of the fund. And if the cost of the fund is brought down, then certainly the indication is towards reviving the economic growth cycle. Should that be the reality, in my viewpoint, I think in subsequent quarters in the calendar year, you would probably see relatively better performance from some of the good quality stocks, if not across the board. As far as the budget 2025 is concerned, in my viewpoint, I think the real game plan would be the art of implementation. AI is a name, I think, which we are already we like it. I think the art of implementation is going to be the key area which one will be looking at. Fiscal deficit management, current account deficit management, the the liquidity management. I think this part is something which the budget is going to make the road clear for this particular arrangement. Along with, I think, the other measures which the government has previously announced, those areas are also likely to be seeing the implementation roadmap going forward.
Hi Deven, this is Lovisha joining in. Deven, I just wanted to understand, whether or not banks are the way to go, because in the past months, during the time of correction, compared to other stocks, banks have relatively held well. So, do you believe that the banks are the way to go? Because today also the market has done well. We have seen some RBI liquidity measures which have stepped up. What do you believe?
And Ravish, I would like to think that if the economy has to grow, some of the larger banks will have to participate. Currently, in last few quarters, I think because of the RBI's reluctance to look into the rate reduction, most of the banks, I think, didn't participate enough, and at the same time, I think they suffered. If I have to use that word, I think largely because of the fact that I think interest costs remain at a higher level. In my viewpoint, I think the banks are the prime beneficiary of rate reduction. Generally, the rate reduction cycle, when it starts, it lasts for about 6 to 8 quarters. So, which means in a sequential quarters going forward, we are likely to see the benefits of the lower cost of funds into the books of the banks, protecting the NIM, of course, but at the same time expanding the AUM book size. So, from that point of view, I think the banks are prime beneficiary. And without generalizing, I would be specific about those banks which have a size, AUM ability, and the size that they have in the balance sheet. Likes of SBI, HDFC, even some of the top ranked private sector corporate banks, including the larger NBFCs like Bajaj Finance, they all remain prime beneficiary of the move on the rate reduction side. So, in my viewpoint, I think adding exposure to the bank would be natural. And some of these banks are available, fortunately, at a valuation which is not expensive. So, to a greater extent, you have a margin of safety as well if you buy in the current times.
That's right. Deven, you also
Sir, on an overall basis, since we have a Lavisha, continue.
No, Yatin, please continue.
So, Deven sir, mid caps and small caps where actually there was froth. You rightly mentioned, there was a lot of exuberance in the IPO markets as well. After a 30-40% correction, do you think it is time to turn selective in mid cap and small cap stocks, or probably you would stay with the large cap at this point in time to probably protect capital, or do you see some return moderation overall for the mid cap and small cap basket?
Yeah, you think apart from looking at the fundamentals into mid cap and small caps, we will also have to look at one more element into them, whether the stock is held by the weak hands. If the stocks are in weak hands, then probably I think even though the companies may be fundamentally appealing because of the corrected price and the valuation, I would think that I think those distressed investors may end up selling their stocks portfolio in a rising market if the stocks start appreciating. So one will have to be a little bit more careful about this particular approach. They are definitely most vulnerable kind of a bracket of stocks because of the size in itself, and at the same time, I think the lower liquidity with them. In a bad market condition, I think that definitely works against the investor. So that is the only caveat. That part I think one will have to look at. But I agree with on one assessment. Yeah, I think the market is giving phenomenal opportunity in some of the quality names if they correct in the price and valuation. And we believe that I think this is a right time. If the market gives a correction of this degree, it will be a right time to buy into. Because whenever the market has corrected so sharply, in the following recovery thereafter, the 60 to 80% kind of appreciation has been made in past experiences. So I think we are confirming that part of it. Selective companies will definitely look good in rising market year after.
That's right. Deven, apart from banks, what else sectors are you looking for? Anything that looks promising after this Q3 results? We are still going through the season, but anything else that you're watching out for?
Yes, bank NBFC of a large size, I think of course they are there. We also like some of the manufacturing businesses, and particularly I think those companies which are playing a significant role uh, in the areas where the growth is there. For example, in power sector, the ancillary to power sector, the companies which are operating as an ancillary to power sector, they look relatively more stable and better. Because on one side you have conventional power, on other side renewable power, the generation, the distribution, and also at the same time engineering part of this entire activity in form of the providing this source supply which is required for the entire sector. For example, I think with EV charging station expanding after the Maruti's entry and the Hyundai's entry, you would probably find that higher number of requirement would be for cables and wires, apart from I think the entire arrangement which is required for charging infrastructure. So I think similar kind of an arrangement will look at I think in railways. Railway is at the same stage at which I think Maruti was in 1980s, wherein I think the higher amount of ancillary development which is taking place now. So next 10 years belongs to those ancillary companies in railways. Similar situation could happen with the defense sector, wherein I think some of the companies which are likely to be prominent companies in next 5 to 10 years. So one thing is obvious and clear that I think while we pick up stocks in respective sectors, including in engineering and R&D space within IT, we believe that I think it's going to be a game of long term, not a short term momentum which we have seen in the recent past.
Overall, Deven bhai, are you satisfied with the kind of performance that we are witnessing in the third quarter so far? Or, probably you think overall the kind of government capex that is happening or corporate earnings recovery that is happening will take another 1 or 2 quarters?
So whole credit goes to India's corporate sector, honestly, if you ask me. I think in a given situation when the demand slowed down, in a given situation when the cost of funds remained high, in a given situation when the government spending had to be delayed because of the election, center level and the state level, and post monsoon the spending has started. Each and every such kind of activity tells me that while driving the car, I think this country is putting the foot on the brakes instead of putting it on accelerator. And that's the reason for which I think the slower growth one has experienced. But despite of this slower growth, I guess I think the corporate sector has performed far better. And the third quarter results, according to me, are far satisfactory. It would have been far better had I think those limitations not came in their way. But I think one would expect that in subsequent quarters the thing would get normalized. RBI's reluctance to reduce the rate of interest also caused significant amount of slowdown activity in the economy. In my viewpoint, I think that should also overcome in this current quarter as well. So hopefully, I think the things are looking far better in the fourth quarter, apart from I think looking at third quarter, which has been far better than I think the second quarter performance that one had seen in the current financial year.
That's right. Deven, then when do you see a meaningful recovery to take place? Because so far it has been lackluster, but then the budget could be announcing some measures to stimulate the economy. RBI rate cuts are expected. Do you expect that, like from the fourth quarter onwards, or maybe from April onwards, we could see some bit of, a cool off and some bit of good meaningful recovery in the markets?
Generally, rate cut percolates into the economy 2 quarters after the effect. So suppose if you have to actually start counting the effect of rate cut, I think it should be from July quarter onwards. That's what my take will be. That real benefit will go to the corporates in true sense. Till that point of time, I think it will probably get absorbed into the system as I see it. But nonetheless, having started date, probably I think you are likely to see the major benefit. And as our market always looks ahead, maybe 2 quarters down the line, things may start looking far better. Market would start discounting 2 quarters in advance. So as far as market is concerned, we will take the lead. Economy will take a while. I think it may probably be seen July onwards as far as the implementation of rate cut is concerned.
Okay, okay.
Right. Deven bhai, last question from our side before we let you go. The expectations from the budget. Do you see a requirement of a tax cut to boost middle income or middle class overall, given the fact that inflation was high? Or would you like the government to maintain their fiscal balance, or would you like 10-15% kind of a growth on the PSU capex side? What exactly do you think would do the magic, especially with respect to the Indian stock markets? Because overall we have seen a lot of state governments distribute a lot of freebies, that has not been also appreciated by the market. So, how do you think the government can do a balancing act between providing relief to the common man as well as balancing out with the capex expenditure?
So, Yatin, I think the answer lies into bringing growth back into the economy. Suppose if you are talking about 12% nominal GDP growth, and on the top of 12% nominal GDP growth, if the tax collection remains buoyant, direct tax collection in first 9 months have shown distinct amount of buoyancy. Should this particular 12% nominal GDP growth come in, the tax collection would remain upwards of 15% on a year-on-year basis as far as the growth is concerned in FY26 is concerned. And so would be the situation with GST. In fact, GST, whatever the hurdle that we are facing, if those hurdles are also removed, then average 1,70,000 crore per month could expand to 1,95,000 2 lakh crore per month. So certainly, I think there is a huge scope for higher tax collection. And if the tax collection is on a higher side, then in my viewpoint, I think the growth revival will have to take place by way of bringing down the tax rate, of course, but at the same time, if it's not brought in, then by way of, I think, tax exemption limit. 7.5 lakh could become gradually 8.5 lakh to 9.5 lakh to 10 lakh is the kind of a roadmap that one wants to see from the government side. Should they announce this roadmap, I would call it, I think, even if you implement it over a 2-year period, but should you announce this roadmap to 10 lakh kind of a 10 lakh tax exemption? To me, I think it will sound good music to ears, bring in new taxpayers with confidence, and at the same time, I think higher amount of spending in the economy. Every tax saved in the hands of a taxpayer will definitely result into higher amount of consumption, which will in turn give more amount of corporate profits and at the same time more amount of GST collection to the government. So in my viewpoint, I think it is a good time to basically consider the high tax exemption and a roadmap has to be announced in that particular manner. Of course, the new tax regime is basically being talked about. So new tax code, as we are talking about, that could possibly pave the way for ease of doing business. That's an expectation. Should that happen, then also the market will cheer about the possibilities.
All right. All right, with that, we have to let you go. Deven, thank you so much for joining. Lovely chatting with you and hope we connect with you soon as well.
Thank you, Lovisha. Thank you, Yatin. Thank you so much.
All right, with that, we have come to an end of this edition of The Closing Bell. Do stay tuned to moneycontrol.com for all the news and updates and market insights. Signing off, Yatin and me. Thank you for watching.